We got the results, and it showed that for the month of May, a net 172,000 jobs were created. So that came in much stronger than expectations. The expectation was that we would add, what the labor market would add, a net 80,000 jobs. Okay, so the jobs report came in really good, but that means that if the labor market is doing so well, then the Federal Reserve is not incentivized to cut interest rates to help the labor markets because, again, the labor market is apparently doing so well, so it doesn't need the help of lower interest rates. So that makes sense, right? So that is why right now, if we look at the probabilities again for the Federal Reserve's June meeting next week, the odds that they'll cut interest rates have decreased from 3.6% to now 1.8%. So it's most likely that they're not going to cut interest rates at this upcoming meeting. I think that there's still that fraction lingering, that 1.8%, because it's going to be Warsh's first meeting as Fed chair, and you never know what the new Fed chair is going to do, right? But I want to show you the highlights of the jobs report, and then I want to show you how it impacts interest rates for the rest of the year. But listen, as you can see, the labor market adding 172,000 jobs was a strong report because, as you can see, just as recently as February, the labor market lost 156,000 jobs in a single month. So it's been swinging, wildly from positive to negative. But apparently, we've been seeing some consistency over the past 3 months. Okay, now I want to show you this. This is the most important data point according to the Federal Reserve, the unemployment rates, which the Federal Reserve has explicitly said at multiple FOMC press conferences. So for the past 3 months, we're talking about March, April, May, it's remained unchanged at 4.3%. And this is down from the recent peak of 4.6% back in November. So listen, relatively speaking, having the unemployment rates in the lower 4% range is considered very low. Again, if the labor market is not struggling, then there's no reason to cut interest rates, especially if the rate of inflation is this high. Okay, so let's do this. Let's check the market expectations to see if that's what's really going on right now. So the next meeting after this one in June will take place on July 29th. So here's what the market expectations were before the jobs report was released. A 3.2% chance that they're going to cut interest rates in July. An 88.5% chance that they're going to keep interest rates the same. An 8.2% chance that they're going to raise interest rates. Now, after the jobs report was released with such great results, the odds for the July meeting changed to this. The odds of a rate cut in July decreased from 3.2% to 1.6%. The odds that they keep interest rates the same decreased from 88.5% to 85.8%. And the odds that they raise interest rates increased from 8.2% to 12.6%. So again, this is for the July meeting. I think that the remainder of the year actually looks much more interesting. So let me show you. Okay, so I want you to take a look at this. I want to show you how the odds have changed so dramatically. I find it fascinating. The last Federal Reserve meeting of this year is going to be on December 9th, okay? The interest rate is currently set to 3.75%. Before the jobs report, the results were released, there was a 1.8% chance that the rates would be lower by then, by that December meeting. A 49.5% chance that rates would be the same by then, and a 48.7% chance that rates would be higher by then. Again, after the results of the jobs report came in so strongly, the odds changed dramatically. So by the end of the year, the odds that interest rates will be lower have fallen from a 1.8% chance to 0.5%, basically close to 0% right now. The odds that they're going to be the same by the end of the year, they've fallen from a 49.5% chance to a 27.5% chance. And the odds that rates will be higher by then have increased from a 48.7% chance to now a 72% chance. So listen, that's the situation. The next meeting in June, which is going to be next week, they're most likely going to leave interest rates the same. But now, since the labor market is not struggling, it's less likely that we're going to get rate cuts this year. And it's actually more likely that the Federal Reserve is going to increase interest rates than decrease them.